Here's what you may not know about interest rates. More importantly, why we expect rates to be lower next year. So when it's cheap to borrow money, we can buy more of the stuff we need and we want. And money was really cheap for a long time. Now, when you take these cheap borrowing costs and you add to it the additional spending money from COVID stimulus and throw in some record-breaking stock market profits, you now have a lot of money in circulation to buy more of those items we need and want. Now, this is all good until there's too much money chasing too few products. Taylor Swift tickets don't cost $2,000 at face value. The demand is just too high and the supply is limited, so price goes up. Arguably, money was cheap for too long with the low interest rates, and at the same time, there was a lot of money in circulation for additional spending. So the end result is higher inflation numbers. And inflation is one of the key factors in why the Fed is raising interest rates. By making money more expensive to borrow with higher rates, inflation should eventually come down as well. So here's a chart of inflation, and as you can see, inflation has spiked, but recently it's begun to tick down as of last month. And here's a chart of mortgage rates, and mortgage rates follow inflation. When inflation is up, mortgage rates are up. When inflation is down, mortgage rates are down. So even though the Fed began to raise interest rates, mortgage rates have begun to cool off because inflation has started to cool off. Inflation is going to come down, and when inflation comes down, so will mortgage rates. So this whole super negative theory that some people have saying the mortgage rates are going to skyrocket, the markets are going to collapse. In order for that to happen, inflation would have to get out of control, which isn't impossible, but it's not likely based on what we're seeing happening right now. The doomsday scenario is always a sexier headline, but the facts support a return to normal.